Where's the weakness coming from? To help us answer that question, Jake Hanley's here, Managing Director, Senior Portfolio Strategist at Teucrium Trading. Jake, good to have you with us. I feel like last time on the show you were talking about how a lot has changed, but not at all much, or not much has changed at all, right? We were kind of talking about crude being in a range and how it's sort of helping this rally we've seen in stocks amidst all the geopolitical tensions and unease. It's had a very level-headed approach towards it all. I'd argue right now, even at 78, one could raise that same point.
Yeah, Ben, nice to see you again. You know, I'm on a trend here right around the 20th of every month. I've been here for
every 4 weeks, so. Right?
Yeah, every 4 weeks. So thank you. It's great to see you. I see you more often than some of my family members. I appreciate it.
Hey, but if you're in my family, that's not necessarily a bad thing sometimes. So
that's too funny. Well, I got to just say that, you know, again, I have no conviction with oil here because largely nothing's changed over the last month, around $80 a barrel. I'm looking at live price 77.85 right now. You know, 76 looks to be a level of support.
Okay.
And, you know, 82, you could draw the line there as being some resistance. And so as long as you're moving sideways in that consolidation area, again, no real conviction. Although I will say just the world's a mess. Okay, so, you know, if I'm going to trade this range, my risk, I believe, is to the upside. The fundamentals, you know, mid-intermediate term here suggest that we should see price pressure continue. Yeah. And so I think that's the directional fundamental trade is to expect for lower prices. But the risk is to the upside just because, you know, we're in a crisis period here.
Okay, I'm kind of reminded, I feel like that was sort of the narrative, the discussion we had last time around 4 weeks ago. You're talking about potentially selling some of these rallies, right? Or a little bit skeptical about some of the rallies. I might have put the word sell them into your, given those words to you, but talk to me a little bit about, I mean, you've got the geopolitical tensions, right, still currently that exist. I remind our viewers, if you have trading products, you know, trading these products, you're susceptible to, it sounds like you're pointing out that short-term, you know, gyrations ultimately, but that longer-term pressure you feel like is on the market.
Yeah, I think it's on the market, and you got to be very careful. Risk premium gets injected into these markets very quickly. And when I say these markets, I'm talking about the commodities markets in general. We saw it with wheat when Russia invaded Ukraine in 2022. You know, we saw it a little bit with oil when Israel and went to war in the Gaza. So you got to be prepared, and you got to be prepared to move quickly in these markets. And I'll tell you, Ben, I'm optimistic intermediate term, okay, for a lot of things. And I just speak to the financial advisors listening, speak to the investors listening right now. I would just say that a lot of folks are feeling that things are out of control. 10 days ago, we had former president almost assassinated. 4 days ago, PBS ran an article saying that President Biden was going to return to the campaign trail, and he saw multiple paths to beating Trump in an election. And here we are, okay? So there's a lot of uncertainty domestically, and I think we're really suffering from an accountability deficit for a myriad of reasons, okay? But that accountability deficit in the United States has led to a lack of leadership in the world, which again increases the risk in the geopolitical crisis that we see right now. Again, I'm optimistic intermediate term because we've seen this throughout history. Right? You know, you can look back to the last hero generation living through the Great Depression, going to fight World War II, and then setting up, you know, the 1950s as a high period in American society where people were pulling together. This isn't my thoughts. This comes from Neil Howe in The Fourth Turning. Anyone who hasn't purchased the book or not familiar with it, public service announcement, get the book. The Fourth Turning is here by Neil Howe. And the optimism comes from the beauty that comes after the crisis, the spring that comes after the winter, okay? And so as we're managing these markets right now, and I can bring it back to the markets, this is a market show, investors, financial advisors are looking for a sense of control in their portfolios, okay? When we think about building control in your portfolio, you're thinking diversification. What is going to add resiliency to my portfolio as we move through this, as Neil Howe puts it, a crisis phase in society and the world at large? I think commodities deserve a look for that exact reason. Grains in particular, you know, we're a grain shop, and I can talk about that. But again, the idea of building portfolio resiliency to weather the storm here, look to commodities. I would seriously encourage investors to do so.
Jake, I do want to talk grains here, but I guess one could argue first that gold's been a reflection of that desire to diversify, right? We've seen it at record highs here, but I also wanted to get a quick thought on copper because, again, last time on we were talking about how you were somewhat bullish copper as far as I remember. It looks like you still are, but there's some uncertainty in terms of China, the geopolitical tensions obviously kind of playing into that reasoning why people are looking to diversify. But again, you're still kind of firm on this bullish copper stance.
Yeah, and I'm firm on bullish copper long term for a lot of reasons we discussed last time. I do not drive an electric vehicle. I have a GM that's a non-electric vehicle, but I know my kids want me to get a Tesla. Okay. Right? So I think that there's going to continue to be a transition to EVs for generations to come. We're going to redo the grid here in the United States and around the world, regardless of President Trump or President Harris. I think that's going to continue to play out. Plus, we have the issue with data centers needing electricity and so forth. So copper's a long-term bullish story. You can't just crank up the mines and the production the way we need to meet the estimated demand that is here. Near term, you got some pullbacks to the breakout area. So, looking for support around that $4 level to me makes a lot of sense. If you break below that, okay, I'm not too concerned intermediate term, but look for some support around that $4 level.
Jake, how old are your kids?
My oldest is 9.
Oh, okay. Well, mine are old enough now when they tell me to buy a Tesla, I just look at them and say, you go buy a Tesla. You can afford one. Let's talk a little bit about grains because you did mention them. I just want to get a quick thought. You said corn under 4 is a lot like crude under 40. We know with crude under 40, we see flows historically coming into oil ETFs. Should we expect that into corn and some of these grain ETFs that have seen pressures?
Ben, from your lips to God's ears, here's the whole story. When you have a commodity trading at or near the cost of production, that suggests that the downside is limited. Yeah. Okay. Yeah. And so, again, similar to the opposite of oil, actually, where I think the trend for oil, you have downside is the expectation and upside risks. For the grains, corn in particular, looking at the futures markets, I think you have sideways at best expectation, and the risk is to the upside. Yeah. We have the weather, we have geopolitics as we've gone over. But looking at historically, you've had 3 times in the last 17 years where front month corn futures have doubled from the levels that they're trading at today. Okay, so if you're an allocator looking for something in your portfolio that can add some stability around the cost of production with some upside potential, I don't think you have to look much further than corn as a market to help you in that scenario. We call it the golden grain cycle. I think we've talked about that before, but it looks like we're seeing that set up nicely again. We're
looking at corn, CORN, the 2-cream ETF, the corn ETF, again, down around the 17, 18 level, but I would argue crude at 80 versus corn at 4, the bigger they are, the harder they fall, right? So a lot more room to the downside to go. So I can understand your reasoning behind that, right? A little bit more opportunity in corn at these levels, even though we are expecting lower prices in crude here. There's some room to go there potentially. Jake, appreciate you joining us here. Good discussion this morning, this Tuesday. Thanks for sharing part of yours with us. Jake Hanley, Managing Director, Senior Portfolio Strategist at 2-cream Trading LLC.